I'm going to kick off immediately with HSBC and introduce you to Xavier Baraton. Xavier is Global Chief Investment Officer of Fixed Income at HSBC. He joined HSBC in September 2002 to head the Paris-based credit research team and became Global Head of Credit Research in January 2004.
Thanks, Chun. Welcome, everyone. I've got a pleasure to start on a very large and diverse topic, also very challenging. I mean, what a difficult year we had in emerging market debt. So, I mean, local currency, double-digit negative returns, currency depreciation, yield increase. Hard currency, we had to cope with the hesitations of the Federal Reserve with downgrades, Brazil, Russia, and overall a lot of volatility. So what I'd like to discuss with you today is two things. First, come back to the asset class and try to look at its merits, its benefits, but also its challenges. Look at the risk and how risk we believe are remunerated. And highlight in particular the structural aspects. I mean, we acknowledge the volatility, we acknowledge some form of adjustments that the emerging countries are going through. It's like it is the last wave, the last shock wave, if you will, of the great financial crisis. After the US adjusted, Europe adjusted, and now emerging countries. But beyond that, we think that it's still a very relevant asset class, very rapidly growing, and providing investors with lots of opportunities. And it will lead me to the second part, which is really about how to access this asset class, how to execute, how to implement an exposure. It's very diverse. There's growing idiosyncratic risk. It's just very difficult to define the EMD beta. Now that we have to consider local debt, corporate hard currency, and sovereign hard currency. So I will walk you through a quantitative study we've worked on to define what could be a relevant blend. Even if you're an active fundamental asset manager, you need to do some quant work in an asset class of such complexity. And we will also have a few words on total return, which is what has been the most effective, we believe, way to access this segment. But let's start right away with a brief introduction. Emerging market debt. It's now a market that is as large as high yield in developed markets. And it keeps growing very fast. It's been double-digit growth over these past dozen years. Particularly on local debt and particularly on the corporate front, which the key benefit is now the diversity in terms of the number of issuers. If you think about it, 15 years ago, the asset class was primarily composed of hard currency sovereign, and as a result, you had, by and large, 20 countries to deal with. So it means concentration, it means idiosyncratic risk that could really affect your exposure, and now we have a much more diverse and diversified investment universe. The one point I would also like to stress, or a couple of points. One is the credit quality. On average, it's an asset class that is investment grade, so that it tends to remunerate yields or returns over this past decade, similar to global high yield, US high yield, but it's actually on average an investment grade. And even if we anticipate further steady deterioration, credit quality, we think that the deterioration will be measured and limited to a couple of notches on this average at the very maximum. On the fundamental aspect of things, I think it's important to. I would like to sum up. Let's put it this way: there's a before and an after for emerging countries, and even if we we go through this adjustment on competitiveness, on reforms. There are gains or improvements, structural improvements that emerging countries have made in the past that will not be reconsidered. And one is the move to the floating exchange rates. It's very important because for two reasons. It acts as a shock absorber and as a result has helped stabilize the economic growth, economic outlook for many countries, especially the larger ones, the BBB or BB rated ones. And mechanically, it has forced the monetary and authorities and administration to conduct a much better governance, much more orthodox policies, generally speaking, and then with a particular focus on controlling inflation. And as a result, as you can see, it has over time allowed emerging countries to build positive current account balances and accumulate reserves over time. So itself contributing to a very virtuous circle, bringing credibility and stability to the currency to a certain point, and mechanically leading to upgrades by rating agencies. These upgrades have also been supported by the stability on the public finance front, as you can see, compared to advanced economies. In particular, in the aftermath of the great financial crisis, emerging countries have been a lot more resilient, and despite some form of economic slowdown, they've managed to maintain pretty much stable public debt to GDP ratios and deficit ratios. This has been really supported by three things, I think, which have, in a way, lifted all boats until a couple of years ago. First, the increase in commodity prices, partly fueled by China's demand. The credit boom, especially over this past half dozen years, fueled by the Federal Reserve, some easy dollar liquidity, and also the industrial globalization, which Asia in particular benefited from. So it's been a golden decade in a way for emerging countries, again, until a couple of years ago, and this has led to steady upgrades. Now, the observation is that even though we think these three super engines have stalled or come to an end, the benefits in terms of debt dependency, in terms of financial balances are fully preserved, and they will not be reconsidered or challenged by the more volatile environment. Let's speak about valuation a little bit. Well, first, if we look at the past, this asset class has really posted very high returns, and it's more the high single digit, some years double digit percentage returns. But maybe more interestingly, it's not been at the expense of the current yields, like it's been in developed markets, where a lot of the outstanding Sharpe ratios we've enjoyed in fixed income were fueled by the yield compression, the spread compression, and leaving very little in the tank, actually. As you can see when looking at the current yield in developed markets, it gives a pretty depressive perspective on what future returns may be when the starting point is around 2%. And it's definitely not the case in emerging countries. There are risks, and we never underestimated them, but the remuneration is also very attractive. Structurally, of course, for developed market investors, you have to talk about diversification and correlations. And here, Obviously, emerging markets debt segments are driven by factors that differ from the ones driving the various bond segments in developed markets. So it leads to correlations that are significantly below 1. And maybe, interestingly, compared to high yield in particular, they exhibit lower correlation vis-a-vis stock market. So in a diversified portfolio built over the long term, it brings clearly benefits by adding new risk factors to your portfolio. Not just rates, not just equity factors, not just credit factors, but also EM specific and a lot of regional or country specific factors. The challenges, over this past couple of years, I think as a debt manager, our AUMs have tripled in 5 years in the global emerging market debt. And I think certainly thanks to performance or the quality of our process, but also because we've been very realistic about the asset class and its challenges. We never try to picture it more rosy than it is. This adjustment has taken place. It had to lead to credit deterioration on one hand and to currency adjustment on the other end. That was the favored adjustment variable, if you will, in this context of structural adjustment. Now, we think these challenges are well remunerated, but let's go through them first and see what happened. Well, as I alluded to, over this past decade, the asset class has enjoyed steady improvement in terms of credit quality and translated into regular upgrades. Now the trend has reversed, and for us, it had not reached a plateau. It had to come back. Now our expectations is that we will remain primarily investment grade. So this ratio, the percentage of investment grade countries will remain above 50%, but there will be more downgrades. But from our perspective, it will be limited to BBB countries going into BBs, or to possible spread widening and restructuring at the very low end of the spectrum, the so-called frontier markets, if you will. And this has really been the result of the fact that, as I said, these super engines that have really been supporting the asset class has now stalled. In this context of structural adjustment, try to regain competitiveness against the US and Europe over this past couple of years. Currency was in a floating regime was the natural adjustment variable, and it's been a pretty spectacular adjustment this year. I will admit, but not to a point that we clearly see value, and I'll come later on to quantify that. It's a healthy mechanism. It's spectacular. It can be a sort of a self-fulfilling risk aversion, but at the same time, it helps these countries buy themselves time to implement structural reforms. They have a breeze of fresh air, if you will, that will allow them to make the structural reforms in employment, liberalization, investment in infrastructure, productivity, what they've been a little bit sitting on over the past decade thanks to the super engines. From an investment standpoint, volatility is something you need to look at, and it's clearly a challenge. And as you can see, regularly the asset class, when looking at the MBIG index, the hard currency, has been shaken with significant drawdowns. Now, these drawdowns are reflected by the bars that are in light. I apologize for if you can't see them, but what you will see is that they've been diminishing over time. So I think it really reflects the structural change in the asset class. We have a better quality overall, and as a result, we have less volatility in the asset class. So it's important when you backtest your allocations to factor that in. The past is not really reflecting what emerging countries are are representing now in terms of credit quality and in terms of volatility regimes. Now, a key challenge in the asset class is now that they're no longer supported across the board by this kind of super engines, commodities, credit boom, industrial globalization. It's no longer a beta play. It's an alpha play, and you need to, there's value, there's potential returns, but it's a lot more, there's a lot more discrepancy. And this is really reflected at two levels. First, when looking at the various segments, when you look at local currency, corporate, sovereign, you don't get the same returns at all, particularly this year. It goes from minus 15% to plus 4%, roughly. So quite a large, quite a broad scope. And at the country-by-country level, it's also very, very diverse. Even the regional patterns are not necessarily so easy to identify. You could argue LATAM is more made of commodity exporters, Asia commodity importers, but there's just as much difference between Asia and LATAM or much difference between Brazil and Ecuador than there is between LATAM and Asia, really. So it creates a real challenge when you decide to allocate to emerging debt. Now, the last challenge is the fact that, to be very candid and realistic, this structural adjustment leading to possible credit deterioration has not come to an end yet, of course. But to measure the opportunity, the only way we could see was to really look at the very bottom-up, angle. I'm not going to walk you through the whole table, and you should get, I believe, the soft copies of this presentation. But clearly, what we've done here is look at every single country in the MBIG index and translate our scenario for the next 3 to 5 years into spreads, into possible defaults or debt restructuring or spread widening. And as you can see, that's where you see columns in the expected default loss and expected loss to the benchmark. So there's quite a few countries, particularly in the frontier space, where we see real challenges going forward, partly linked to relatively low commodity prices. But the more interesting point is at the bottom. When we factor that in, plus scenarios on that reflect spread widening, US interest rates going up, we still end up with positive returns over the next 3 and 5 years. We do this study regularly every quarter. We update it, and it's the first time in a year and a half that we end up with numbers that are significantly positive. You could say statistically positive, not in the low single digit, but clearly in the mid to a high single digit. So it's really signaling a much better entry point at the moment. You're long-term investors. You're not necessarily trying to find the best timing, but it shows that the asset class, despite this fundamental negative trend, is something you should keep an eye on, because the yields on local debt, on hard currency, the currency levels at the moment, we see them as fairly valued. Now, the last challenge before we talk about implementation is the concentration of the indices. It's a very technical and practical aspect. When you invest in EMD, you have to choose, well, you believe you have to choose an index, and these indexes are very segmented. It's hard currency, sovereign, corporate, local debt, and they have plenty of flows. They're very well calculated, but they have long duration, they're very concentrated. So defining a beta and be sure that your beta is not going to be affected by too many undesired weaknesses or side effects is a real challenge that we wanted to tackle now. So it takes me to the second part, how to access the asset class. As a brief starting point, what we've done is to look at the risk factors. So it's a statistical multi-regression to really try to understand what drives the various indices. And each color represents a risk factor. So there's credit risk, equity risk, volatility. The interesting thing, maybe, and I'll move here to show it, is local debt is probably the one segment where you get a sizable true emerging market risk. Plus, let's say a country, what we call unexplained, but it's primarily country risk. When you get into corporate debt, you get a lot of credit risk. So it's not necessarily truly genuine emerging market exposure, but you should consider emerging market corporates anyway, just for the sake of diversifying even better compared to developed markets, and possibly for higher risk premiums, as it's the case usually. And hard currency is also providing diversification. But you can see that the way the global risk factors affect the three main segments is very different. So what we've done is we've used a factorial approach to find the best combination with two scenarios. The first one is we assigned each factor the same prospective Sharpe ratio, and the second scenario is we give a little premium to corporate and local debt. Corporate because the remuneration for the same ratings is higher. Structurally, they better remunerate than developed market corporates. And local debt because we consider that at this particular moment in time, we are not only at the lows of a cycle, but also at a historical low point in terms of valuation. So it leads to a calculation which means from this, which aims at identifying the Sharpe ratios, the expected excess return, and the volatility, starting from a pure exposure to sovereign hard currency, as you can see here. And it leads to a Sharpe ratio of 0.24 over the next, I think the investment horizon is 5 years. But the scenario one shows that by combining different indices, we can improve the Sharpe ratio already pretty substantially. I mean, when you can improve by 0.04, it's already quite meaningful. In the second scenario, which is probably a more realistic one, bearing in mind that, as I said, the past in the emerging market is not necessarily a good guide to the future, in the sense that the volatility, it's an asset class that has structurally changed in terms of quality. If you take high yield, it's always high yield. I mean, there can be changes in the breakdown between triple Cs, double Bs, but for EMD, it's really an asset class that has changed very structurally. And here, you can see that as a result, you can reasonably expect much higher Sharpe ratios, again, by combining. So it shows that even within EMD, combining indices is very beneficial, and particularly when building blends that factor in local debt, that take local debt and corporates into account. So compared to the starting point, you can both reduce the volatility and increase the expected premium, the expected return with by building a blend. So at this point, our first recommendation is to really look at the asset class without being too concentrated on one segment. I mean, we talked about all the flows, the concentration of indices, the growing idiosyncratic risk. The best way to tackle that and be successful in allocating in EMD is to construct hybrid exposure, hybrids indices. What in developed markets we could call aggregate, or and that actually never really are only starting to develop at the moment. Just to show you how the kind of exposure it would take you in a more diverse portfolio. It's not exactly the same mix, but you can improve your Sharpe ratios by about 10% by moving from a very traditional portfolio made of fixed income and equity, quite classic, with a long-term horizon. So we have a majority of stocks. By introducing emerging markets. We've also introduced high yield, just to be fair. But of course, the emerging market exposure is bringing new risk factors, or is bringing risk factors that are better remunerated, particularly the credit ones, and a bit of an equity risk factor component that is better remunerated in terms of historical sharp or remuneration of the segment. Finally, so the blend is one effective way to approach emerging markets and implement an asset allocation. The other way we've been very successful with over this past couple of years is total return. Because in total return, and we've now developed a range of total return solutions, we try to not only manage the exposure, and as you can see, this is historically the investment ratios we've had in this strategy over this past 3 years, with a view to capture the upsides, minimize the downsides, and with a particular focus in minimizing the drawdowns. But we also benchmark agnostic, so it's not I would not define it as a best idea, but it's definitely a go anywhere. So any bottom-up opportunity makes its way into the portfolio for its own merit or because it helps diversifying further the portfolios. So you can see the way we are exposed can vary between little local debt, for instance, here back after the taper tantrum when we increased the investment ratio. We were defensive before, and we increased substantially. We've rebuilt our exposures back in August and September this year, but this time with a lot more local debt exposure. Just acknowledging the very attractive levels at the country-by-country basis. This is many institutions have moved to this approach as it addresses a lot of the challenges, not only the question of building effective exposures, but also managing them more actively over time and rotating what we can do here with the total return solution. What it leads to is this kind of returns. Just and I'll conclude on that. We show here the returns and standard deviation over 10 years and 3 years for the industry benchmarks indices. The blend that is a reference for our universe. It's not an index we track, but it helps define the kind of volatility we're talking about. So it's 50% hard currency, 25 local bond, local rates. And that's what we've delivered with this total return strategy. So in a nutshell, by managing the top-down aspects and go anywhere, we want to deliver the returns of the asset class and minimize the volatility. Usually we target between 50% and 75% of the volatility of the asset class. And I think interestingly, particularly for long-term investors with solvency ratios, and we manage drawdown with a particular attention paid to risk, of course with slicing and dicing, but also with systematic backtesting of our portfolios over time. So really taking the changing correlations into account. And you get exposure to an asset class. It's not an absolute return in the sense going long-short all the time. The correlation with the benchmarks is relatively high, usually around 0.7, 0.75. So if you have an asset allocation, you want an EMD exposure, you'll get it. You'll get the return of it, but you have a good chance, if we're successful, to reduce a lot of the volatility that occasionally EMD can generate. There are a few more slides, but if you get soft copies, you'll get soft copies pretty soon. If you get copies, I'll let you have a look at it. A few slides on the process overall and on the backtesting, which is a very critical part in our process, and if not unique, at least very specific to the way we invest in the asset class.